So picture this. You're sitting at your desk, watching the market. You see this massive, just explosive short-term rally.
Oh, yeah, everyone knows that feeling.
Right. The candles are huge. The momentum is, well, it's undeniable. And the narrative on your feed is suddenly overwhelmingly bullish.
Yeah.
Everything is pointing up.
Yeah.
So you make your move.
You jump in.
Yeah, you bet the farm, thinking, okay, this is it. This is the permanent shift I've been waiting for. You sit back, waiting for the profits to roll in, and then, 2 days later,
You're stopped out.
you are stopped out. The market violently reverses, and you are left staring at a red screen, completely bewildered. Sound familiar? Because I think we've all been there. Welcome to the Deep Dive. Today, we are looking at an incredibly dense set of institutional frameworks, macro research, really trying to figure out why retail traders constantly get trapped like this.
It happens every single day.
It does. So our mission today is to distill decades of market history and complex financial theory into a single, unified framework. We want to give you the ultimate conceptual architecture to stop reacting blindly to price action and start reading the market's true structural hierarchy.
Because that ambiguity you just described, that feeling of being bewildered by a chart, of not knowing why a setup failed, that is the single biggest destroyer of capital in the retail trading space.
Yeah, without a doubt.
The biggest edge you can have in trading isn't having faster data. It isn't possessing some, secret proprietary momentum indicator or having a direct fiber optic line to an exchange.
Right, it's not about speed.
No, the ultimate edge is conceptual clarity. If you do not understand the environment you are operating in, your strategy is essentially a coin flip. It really is.
Okay, let's unpack this right away because we are talking about smart, dedicated, often mathematically gifted traders making these incredibly frustrating mistakes.
Highly intelligent people, yeah.
All right. These are people who spend 10 hours a day staring at screens. They backtest strategies. They read earnings reports. They put in the work. So why do they keep getting caught on the wrong side of the move? If they have all the data, why do they fail?
Well, they fail because they lack a conceptual language for what they are actually looking at. You see, financial markets operate on multiple, deeply interconnected layers.
Okay.
They are incredibly complex, multi-dimensional ecosystems. But what do most traders do? They collapse all of that living, breathing complexity into a single two-dimensional chart.
Just a line on a screen.
Exactly. They look at a price line on a screen and expect it to tell them the entire story of global capital flows. And when you collapse that complexity, you lose your edge entirely.
It's the trap of conceptual confusion.
Yeah.
But let me stop you there, because I hear traders throwing around words like regime and structure and campaign all the time on social media.
Oh, constantly.
Yeah. So are we just having an academic debate over semantics here?
Yeah.
If the line on the screen goes up, who cares what you call it?
It is absolutely not just semantics. Blurring these terms actively destroys portfolios. When you treat those concepts as synonyms, you systematically misread the mechanics of the market.
Give me an example of how that actually plays out.
Sure. Let's say a short-term, sentiment-driven move happens. If a trader lacks conceptual clarity, they mistake that localized burst of buying for a long-term structural shift.
They think the whole trend changed.
Right. Or, conversely, they see a natural, healthy consolidation in price, just a brief pause in the market, and they interpret it as a massive macro reversal. You end up treating a localized weather event like global climate change.
Oh, wow. So the psychological pitfall here is our intense human desire for simplicity. We want the market to be easy. We want one rule. We want one moving average crossover or, one perfectly drawn trend line to tell us everything we need to know.
It is deeply ingrained in human nature to seek patterns and reduce complex systems to simple binaries. Up or down, red or green, buy or sell.
Yeah, our brains are wired for that.
Exactly. But treating financial markets as a single system driven by a single force is a fatal analytical flaw. Think about what a financial market actually is mechanically.
It's a lot of different moving parts.
It is the aggregate intersection of central bank policy, global liquidity conditions, geopolitical tension, corporate earnings, algorithmic execution, and human emotion. It is a hierarchy of interacting dynamics.
So when a trader is just looking at a 15-minute chart, trying to divine the future of the global economy based on a few squiggly lines,
they are looking through a keyhole and trying to paint a landscape. It just doesn't work. Let's look at the mechanical impact of this. When you mislabel what you see, You fundamentally mismanage how you respond.
Meaning your actual execution gets ruined.
Exactly. If you interpret a temporary influx of capital as a brand new multi-year macro regime, your entries will not align with the actual context. Your position sizing will be completely wrong.
Because you think you are catching the bottom of a 10-year bull run, so you use leverage. You size up massively.
Yes, you bet the farm. And your exits will happen entirely at the wrong time. You will hold on to losing positions as the market turns against you because your internal narrative keeps screaming, well, but the macro regime has changed. The chart told me so.
Right, you're arguing with the tape.
Yeah. Your internal narrative shifts every time a candle closes red, which creates an incredibly stressful reactive loop. You are always one step behind the actual flow of capital.
It's like trying to play a game of 3D chess, but you genuinely think you're looking at a flat checkers board.
That's a great way to put it.
You're moving your pieces, your capital, based on a reality that doesn't actually exist. You think you're capturing a checker, but a piece drops in from a completely different vertical axis and just wipes you out.
That analogy hits the mark, but let's make it even more mechanical. You're playing on the wrong axis entirely. You're making decisions based on a flat interpretation of a multidimensional system. You are trying to solve a physics equation using basic addition.
Now here's where it gets interesting. To actually survive and thrive in this environment, we need to separate this multidimensional system into its distinct layers.
I have to.
We have to stop blurring the lines. We need to build a structural hierarchy starting from the very top. So let's talk about layer one, the absolute foundation, the market regime.
The market regime is the bedrock. If you do not understand the regime, nothing else you do mathematically matters in the long run.
It's that important.
It is everything.
Yeah.
By definition, a market regime is the broad macroeconomic environment that defines how capital behaves across multiple asset classes simultaneously.
Across multiple asset classes, that is a key distinction. Because we are not talking about the price action of a single tech stock. We are not talking about a sudden surge in a specific cryptocurrency.
No, not at all. It is about the underlying atmospheric conditions that shape the global flow of money. The regime answers the single most fundamental question in finance. What incentives are driving capital right now?
Let's hover on that word for a second. Incentives. Because capital institutional money, the trillions of dollars moving around the globe, sovereign wealth funds, massive pension funds, it doesn't just move because a chart looks pretty.
Definitely not.
It moves because it is mathematically incentivized to do so.
Capital is completely agnostic. It does not have loyalty to a particular company, a particular sector, or a particular country. It is ruthlessly driven by the pursuit of yield and the avoidance of risk.
Just pure math.
Pure math. And the regime is what sets the parameters for that pursuit. Regimes are incredibly slow-moving phenomena. They unfold over months and very often over years.
Okay, let me push back on this, though. Because if these regimes take months or years to play out, why should a day trader who is flat by 4 p.m. care?
A lot of people ask that.
Right, because if I'm trading a 5-minute chart, global macroeconomic incentives feel completely irrelevant to my next trade.
Yeah.
Aren't macro regimes just for, portfolio managers and economists?
That is the most common and frankly the most dangerous misconception in retail trading. You might think the macro regime doesn't affect your 5-minute chart, but the regime dictates the micro-liquidity of the order book you are trading against.
Wait, explain that connection. How does a massive, slow-moving macro force mechanically alter a 5-minute chart?
Think about it like the hydrodynamics of a river. A risk-on macro regime is like opening the massive floodgates of a dam. The water, which represents global capital and liquidity, is deep, fast, and abundant.
Okay, I'm picturing it.
If you're steering a boat, which represents your short-term trading strategy, mistakes are easily forgiven because the sheer volume of water carries you forward. In the market, this means the order books are thick.
Right.
Market makers are willing to take the other side of your trade. Breakouts follow through cleanly.
Because there is so much money sloshing around the system that every dip gets bought instantly.
Correct. But now consider a risk-off regime. The central banks close the dam, the river dries up. Suddenly, all the jagged rocks at the bottom of the riverbed, which were always there, by the way, are exposed.
And your boat crashes.
Your boat crashes not because you forgot how to steer, but because the water level dropped. Mechanically, on your 5-minute chart, this means institutional market makers pull their bids.
The liquidity vanishes.
Yes. The order book thins out. When you try to execute a trade, you experience massive slippage. What used to be a clean structural breakout suddenly becomes a violent, choppy trap because the underlying liquidity simply isn't there to support the move.
So the day trader gets chopped to pieces and blames their technical indicator when in reality, the river just dried up.
Precisely the issue. We have to look at the massive structural forces that control that dam. We're talking about monetary policy.
Like what the Fed is doing.
Exactly. Are central banks injecting liquidity into the overnight repo markets, or are they draining it? We're talking about inflation dynamics. Is cash holding its purchasing power, or is it melting? We are talking about the cost of capital. These tectonic plates determine whether global capital feels encouraged to take risks or whether it feels terrified and seeks safety.
So if we break down the different types of regimes, we can see how they completely alter the mechanics of the market. Let's look at the classic risk-on regime. What are the actual mechanics behind it?
In a pure risk-on regime, the cost of borrowing money is incredibly low. Central banks have dropped interest rates. Liquidity is abundant. Because cash in a bank account yields essentially nothing, institutional capital is forced further out onto the risk curve to find returns.
They have to chase yield.
They do. The overarching incentive is to seek growth. Capital flows aggressively into equities, high-growth technology stocks, speculative ventures, and higher-yielding emerging market currencies.
Because the mathematical penalty for taking a risk is practically zero. If you can borrow money for 1% and a tech stock gives you an 8% return, you leverage up and buy the tech stock.
That is the exact mathematical incentive. But contrast that with a risk-off regime or a tightening cycle. Something shocks the system. Maybe inflation spikes or a geopolitical crisis erupts.
And everything changes.
Central banks are forced to raise interest rates. Suddenly, the cost of borrowing skyrockets. The incentive shifts instantaneously from let's make money to we need to protect money.
And the mechanics of the market completely invert.
They do. Capital violently flees those high-growth assets. If a hedge fund can suddenly get a guaranteed 5% yield simply by holding short-term U.S. Treasuries, why on earth would they risk their capital on a volatile, unprofitable software company?
They wouldn't. It makes no sense.
They wouldn't, so they liquidate. Capital rushes into safety and liquidity treasuries, the U.S. dollar, highly defensive sectors.
And then you have inflationary regimes where holding cash guarantees a loss of purchasing power, making real physical assets like commodities, energy, and agriculture incredibly attractive. Yeah. Each of these regimes creates a highly specific, rigid incentive structure.
And that structure rigorously governs how capital is deployed across the globe. But here is the crucial takeaway for anyone listening. Regimes do not tell you when to execute a trade.
Let's make sure that point lands. You cannot use a macro regime shift to time your entry on a Tuesday morning.
You cannot. They're too broad, they're too slow. You can't look at the Federal Reserve's balance sheet and know exactly what minute to buy an S&P 500 futures contract.
Right.
What the regime does tell you is what is worth trading and why. It tells you whether you should be looking for long setups or short setups. It defines the boundaries of the playing field.
Let's zoom out for a second.
Okay.
So we've established that the macro environment dictates the flow of trillions of dollars. It sets the incentives. But I can't load up global monetary policy or interest rate expectations on a standard candlestick chart.
No, you can't.
How does a massive invisible force like a rate hike actually leave a physical footprint on the screen? What does it look like? That brings us to layer 2. Market structure.
Market structure is where the abstract macroeconomic theory becomes visible reality. It is the observable organization of price within a given regime. It is the way the market physically expresses itself through trends, ranges, consolidations, and transition phases.
If the regime is the underlying geology of the Earth, the tectonic plates shifting beneath the surface, then the structure is the mountain range that gets pushed up. It's the observable behavior caused by the invisible environment.
That is a highly accurate way to visualize it.
Wow.
And there is a critical, unbreakable rule here that most retail traders fail to grasp. Structure does not exist independently.
Okay.
It is entirely subservient to the regime.
Let me play devil's advocate here. Because a lot of people listening have spent years studying classic charting books. They know technical analysis. They know what a head and shoulders pattern is.
Right.
They know what a double bottom looks like. Are you suggesting that identical technical patterns, like the exact same geometric shapes on a chart, can behave completely differently depending on the macro regime?
I am stating that as an absolute fact. And this is where purely technical traders systematically lose their edge.
Wow. Okay, break that down.
Structure is a reflection of capital flow, not the cause of it. Imagine a beautiful, textbook bullish breakout pattern on a daily chart. It looks perfect. In a stable, risk-on macro environment with abundant liquidity, that breakout will likely result in a clean, persistent, highly profitable trend.
It works exactly like the textbook says.
Right. The structure confirms the regime, the order books are thick, the market makers are facilitating the move, and the capital follows through.
Because the underlying incentives were already pushing institutional money in that direction. The chart pattern was just the spark that ignited the fuel that the regime had already poured on the ground.
Exactly. But now, take that exact same bullish breakout pattern, the exact same sequence of candles, and place it in a highly uncertain, liquidity-constrained, risk-off regime. What mechanically happens when that pattern triggers?
Well, it breaks out for a day, maybe a few hours. It hits the scanner. It sucks all the retail breakout traders in, and then aggressively reverses, completely collapses, and stops everyone out.
Yes. Because in uncertain regimes, structure fractures. It breaks down into choppy ranges, false breakouts, and erratic whipsaws.
So the shape is the same, but the outcome is totally different.
The geometric shapes on the chart might look identical for a brief moment, but the follow-through is completely non-existent because the underlying capital incentives are entirely different. The dam is closed, the river is dry.
The money isn't there to push it higher.
Right, the institutional bids aren't there to support the higher prices. Without the correct macro context, market structure is dangerously misleading.
This completely reframes how we should view technical analysis. But I have to ask, on the flip side, isn't macro analysis completely useless without structure?
Oh, absolutely.
I mean, you can be the smartest economist in the room, predicting a global recession with perfect accuracy, analyzing supply chain bottlenecks and repo rates. But if you don't know how to read the market structure, you have no way to actually put a trade on. You're just a highly educated spectator getting angry at the television.
You are absolutely right. Knowing the macro environment gives you the directional bias, but structure is the interface you use to manage risk. Without structure, macro analysis is just abstract theory.
You need a place to enter and exit.
You need structure to define where your thesis is wrong.
So what should a trader actually be looking at when they analyze structure? We aren't just looking for animal shapes in the clouds. What are the mechanical components?
We are looking at the foundational components of price action. First, trend direction. Is the market systematically making higher highs or lower lows?
Simple enough.
Second, we look at volatility expansion and contraction. Is the range of the daily candles getting wider, indicating panic or aggression, or tighter, indicating accumulation or equilibrium?
We're looking at key liquidity zones, right? Where are the logical places that buyers and sellers have historically stepped in?
Yes, exactly.
And the sequence of breaks like. How does the market actually behave immediately after it breaks a key level? Does it accelerate or does it immediately retrace?
Those components form the language of price. They are the translation layer. They translate broad, invisible economic conditions into measurable patterns that you can interact with on a screen to define your risk and reward.
But the real story is, well, structure shows us the behavior. It shows us the footprints on the path. But what is actually making those footprints? A geometric chart pattern doesn't mechanically move price.
No, it doesn't.
Trend lines drawn on a screen do not move price. The only thing that physically moves the price of an asset from point A to point B is aggressive market orders. Capital.
Which brings us to the third layer of the hierarchy. Layer 3, the market campaign. We have to follow the money.
A market campaign is a sustained, directional move driven by institutional capital. It is not random noise. It is not retail traders buying a few shares on a trading app. All right, it's the big boys.
It is purposeful, intentional movement rooted in the underlying incentives of the regime and executed through massive, large-scale positioning.
This is where theory hits the pavement. This is the execution level. Why does an institution suddenly decide to move $3 billion into a specific sector? What mechanically sparks a campaign?
Campaigns are sparked by massive structural divergences. They are driven by asymmetry. For example, consider a profound divergence in global monetary policy.
Okay, give me a scenario.
If the United States Federal Reserve is aggressively raising interest rates to combat inflation, while the Bank of Japan is stubbornly keeping their interest rates pinned at zero, that divergence creates a massive structural imbalance in the currency markets.
It creates a mathematical certainty. Capital will flow from Japan to the United States to capture that massive difference in yield.
Yeah.
The money has to move.
It is forced to move. Or consider shifts in commodity dynamics, a sudden structural supply shock in global energy markets. These drivers create conditions where betting on one direction becomes mathematically, logically, and systematically more favorable than the other.
This is an unfair fight.
Exactly. When an institution identifies this asymmetry, they initiate a campaign.
I want to dig deep into the mechanics of this because I think retail traders have a massive blind spot here. How does a hedge fund actually execute a campaign? If they need to buy $2 billion of a specific asset, they can't just log into a broker and click buy market. If they do that, what happens?
If a massive fund executes a multi-billion-dollar market order all at once, they will instantly consume all the liquidity in the order book. They will rip the price of the asset up 10, 20, maybe 30% in a matter of seconds.
Which sounds great for anyone already in the trade.
Sure, but for the fund, they would completely ruin their own entry price. They would suffer catastrophic slippage.
So they have to hide their size. They have to execute in phases.
Exactly. The sheer size of institutional capital requires a phased, methodical approach. A campaign typically begins with the accumulation phase.
Okay, how does that work?
The smart money uses algorithms, specifically VWAP, volume weighted average price algorithms, to quietly build a position over time. They buy in tiny increments over days or weeks. They actively absorb the selling pressure of retail traders. They buy the dips.
And if you're reading the structure correctly, how does that accumulation phase mechanically manifest on a chart? Because they can't hide entirely, right?
They can't. On a chart, institutional accumulation often looks like a prolonged consolidation. It looks like a tight, frustrating range at the bottom of a downward trend. Retail traders get bored and sell, and the institutions quietly buy every share offered at that low price, effectively building a floor. They are building their base.
Once that position is fully built and the macro catalyst finally aligns with their thesis, what happens next?
We enter the expansion phase. The institution stops hiding their orders and begins aggressively crossing the spread. They initiate the sustained directional move.
The breakout.
This is the trend. This is where institutional participation provides the actual physical volume and the unwavering conviction to sustain a move over weeks or months. They run the stops of the short sellers, forcing them to buy to cover, which adds even more fuel to the campaign.
So these incredibly powerful trends we see on charts, the ones that seem to go straight up for months, these aren't just random occurrences. These are highly structured, deeply intentional operations by the biggest players in the world, acting directly on the mathematical incentives provided by the regime.
Yes. And eventually the campaign reaches the distribution phase. The macro environment starts to shift. The original asymmetry that sparked the trade begins to close.
The trade is over.
The institutions realize it is time to take profits. But again, they can't just click sell market. They need liquidity to sell into.
They need buyers.
They need late arriving buyers. So they use the bullish momentum and the positive news headlines to quietly offload their massive positions to retail traders who are just now noticing the trend and experiencing FOMO.
They distribute their bags to the people who buy the exact top.
Precisely the mechanic. And this highlights the total unbreakable dependency between the three layers. A regime without campaigns is just dead air. It's theoretical potential energy with no kinetic release.
Because no one's pushing the buttons.
Right. A central bank can lower rates, but if institutions don't execute campaigns, prices don't move. But conversely, a campaign without a supportive regime, that is a house built on sand.
It's just a short squeeze or something.
It is a counter-trend squeeze that is completely unsustainable. It will collapse the moment it hits resistance because there is no fundamental macroeconomic wind at its back.
Okay, we have our three puzzle pieces on the table. Regime, structure, campaign. How do they fit together to form a unified theory of the market? Let's look at the hierarchy in action.
The unified framework is a rigid top-down hierarchy. It flows in one direction and one direction only. Regimes dictate structure. Structure facilitates campaigns.
Okay.
If we connect this to the bigger picture, you can distill this entire framework down to a very simple, very powerful mantra.
I am a huge fan of conceptual mantras. Let's hear it.
Regime sets the incentives. Structure shapes the behavior. Campaign drives the movement.
Regime sets the incentives. Structure shapes the behavior. Campaign drives the movement. If you are listening to this, I seriously recommend writing that down on a Post-it note and sticking it directly to your primary monitor.
It will save you a lot of money.
It really will. Because if you are building a trading strategy, you absolutely cannot skip a step. Each layer depends entirely on the one above it. You cannot comprehend the campaign if you don't understand the structure, and the structure is meaningless noise if you ignore the regime.
What is crucial to understand here is that while they are intimately interconnected, You must analyze each layer on its own terms, using the correct tools for that specific layer.
Right. You wouldn't use a thermometer to measure the speed of the wind.
Exactly. You cannot use a structural tool like a Fibonacci retracement or an RSI oscillator or a moving average to diagnose a macro regime.
Right. That makes no sense.
A moving average on a daily chart cannot, under any circumstances, tell you what the European Central Bank is going to do with interest rates next month. It is mathematically incapable of doing so.
And conversely, you can't use a macroeconomic thesis to time your entry down to the minute. You can't read a GDP report and know exactly where to place your stop loss. You have to respect the boundaries of each analytical layer.
So what happens when a trader inevitably mixes these up? Because it happens every single day.
All the time.
Let's look at the financial carnage that follows when these layers get crossed. Let's go through the major pitfalls.
Let's do it, because these pitfalls are where we see the absolute most capital destruction in the retail space. Mistake number 1, treating campaigns as regimes.
This is the classic trap of extrapolation. This happens when a trader sees a really strong, violent trend in the market. A powerful institutional campaign is underway, perhaps a massive short squeeze.
It looks unstoppable.
Because it's moving so fast, generating huge green candles and dominating the financial news cycle, the trader assumes this is a brand new, permanent macro reality. They assume the underlying regime has fundamentally changed.
I call this the FOMO trap. The result of this mistake is catastrophic overextension. You think, wow, this is the new normal. I cannot afford to miss out on this paradigm shift. So you commit heavily.
You go all in.
You use leverage, you average up, and you do it at the exact mathematical moment the temporary campaign is reaching its distribution phase. You are buying the exact top because you confused a temporary institutional sprint with a multi-year macroeconomic marathon.
Exactly. You misdiagnosed the layer. Now consider mistake number 2, ignoring regimes when trading structure. This is the pure chartist's dilemma.
This is the trader who proudly turns off the news, ignores the economic calendar, deletes all the macro indicators, and just stares at pure candlestick geometry.
They focus entirely on the microscopic movements of the chart and completely ignore the macro weather outside. The result, you take a trade that looks mathematically, aesthetically perfect on a screen.
A beautiful flag pattern.
It is a textbook wedge breakout. But the moment you click buy, it gets absolutely crushed, seemingly out of nowhere. The price cascades against you.
And the trader sits there wondering why technical analysis failed them. But it didn't fail. They just tried to buy a tiny structural dip while the entire macro regime was screaming sell everything. They bought a micro rally in the middle of a global liquidity drain.
They were swimming directly against dominant institutional capital flows. And finally, we have mistake number 3, confusing structure with direction.
Let me stop you and ask for clarification on this one, because aren't structure and direction essentially the same thing? If the structure consists of higher highs and higher lows, isn't the direction intrinsically up?
Not necessarily, and distinguishing between the two is vital. A market can have a clean, upward structural trend on a chart, higher highs and higher lows, but it might be moving on incredibly low volume, driven entirely by retail trading algorithms with absolute zero institutional backing.
It's a ghost town.
Exactly. Thinking a clean structural trend automatically means a powerful, institutionally driven campaign is underway is a massive error.
Ah, I see. Because without the underlying campaign backing it, without the real heavy institutional money pushing it, you vastly overestimate how durable that move actually is. It's a hollow trend.
Very fragile.
The first sign of real institutional selling hits the tape, and that beautiful structural trend collapses like a house of cards because there were no heavy bids underneath to support it.
You are trusting a mirage. The structure was there, but the campaign was absent.
So how do you catch yourself before making these errors? How do you actually train your brain to see the matrix? To truly internalize this framework, we need to see it play out in the real world. We need to look at history. Let's transition into the masterclass portion of this deep dive. Let's look at massive multi-layer case studies to see exactly how all 3 layers mechanically interact in real time during extreme market events.
Let's start with one of the most violent market events in modern history, the 2020 COVID crash and the subsequent unprecedented intervention by the Federal Reserve. This is a masterclass in the 3 layers.
Let's break it down step by step. Step 1, identifying the regime. In late February and March of 2020, what was the macro weather?
The regime shifted overnight into the most extreme risk-off environment imaginable. The global economy physically shut down. The mathematical incentive became pure, unadulterated preservation of capital.
People just wanted cash.
The overnight repo markets, the plumbing of the financial system, began to freeze. Global liquidity evaporated as institutions desperately hoarded U.S. dollars. That was the regime, a total liquidity vacuum.
Okay, step 2, observing structural behavior. How did the price actually react to this new reality on the charts? What did the structure look like?
Because the regime was defined by a liquidity vacuum, the structure of the market completely fractured. Bids were pulled. We saw historical volatility expansion.
It is terrifying.
The market didn't just trend down, it gapped down violently. We hit circuit breakers and limit downs day after day. The structure was chaotic, illiquid, and characterized by massive face-ripping ranges. Normal technical patterns ceased to function because the hydrodynamics of the market had broken.
And step 3, campaign execution. Where was the smart money going during this chaos?
Institutional capital was executing campaigns of mass liquidation. They were forced to sell anything they could, not necessarily what they wanted to, just to raise cash. But then the regime shifted again.
The Federal Reserve steps in.
Yes. The Fed announces unlimited quantitative easing. They drop rates to zero. They open massive swap lines. Almost instantly, the central bank forcibly alters the macro regime from a liquidity vacuum to an environment of infinite guaranteed liquidity. The cost of capital goes to zero.
So the regime completely flips from risk-off to hyper-risk-on. How does the structure respond?
The structure instantly reflects this. The massive, volatile downward ranges stop. The market forms a violent V-bottom. Volatility begins to contract, and we see the immediate formation of aggressive, persistent, higher highs and higher lows. The order books thicken up.
And what were the campaigns? Where did the institutions route those trillions of dollars of new liquidity?
Because the regime guaranteed cheap money, institutions launched massive campaigns into assets that benefited most from a lockdown economy with 0% interest rates.
The stay-at-home stocks.
Right. They aggressively accumulated mega-cap technology stocks, software companies, and eventually speculative assets. If you understood the regime shift, the structural V-bottom wasn't a mystery, and the campaigns into tech stocks were mathematically predictable.
That is an incredible example. But let's look at the exact opposite scenario to prove the point. Let's look at the 2022 inflation and tightening cycle.
A perfect counterexample. Step 1, the regime. In 2022, inflation spikes to multi-decade highs. The Federal Reserve is forced to aggressively raise interest rates, pulling liquidity out of the system. The era of free money ends.
The punch bowl is gone.
The cost of capital skyrockets. The new regime dictates that capital must seek guaranteed yield and abandon unprofitable growth.
Step 2, the structure. How did the charts look in 2022?
The structure was incredibly deceptive. It wasn't a straight line down like 2020. It was a persistent, grinding downward channel, but it was constantly interrupted by violent, sharp, short-covering rallies.
Oh man, those rallies were brutal.
You would see a massive 5% rally over 3 days that made every retail trader think the bottom was in.
Why did those rallies happen mechanically?
Because the market was highly shorted. When a piece of slightly less terrible economic data came out, algorithms would buy, forcing short sellers to cover, which created a structural spike.
A short squeeze.
Exactly. But because the overarching macro regime was still pulling liquidity out of the system, those structural rallies had no institutional campaign backing them. They were hollow. They fractured at the first sign of resistance, trapping retail buyers.
And step 3, the campaigns. Where did the smart money hide in 2022?
Institutions abandoned the tech campaigns of 2020. They actively distributed those assets. Instead, they launched campaigns into energy, commodities, and highly defensive cash-rich equities. They flowed into assets that benefited from the inflationary regime.
The lesson from comparing those two events is profound. The regime explained the why. The macro backdrop told us exactly why capital was terrified in 2020 and why it was seeking yield in 2022. The structure showed us the how.
Yes, the mechanics of it.
It showed us the limit downs in one year and the deceptive bear market rallies in the other. And the campaigns revealed the where. It showed us the specific sectors the institutional money was flowing into and out of. If you ignore even one of these layers, you are operating with a lethal blind spot.
If you only look at the regime, you might be right about the economy, but you'll get chopped to pieces by the structural volatility of bear market rallies.
Right.
If you only look at the structure, you'll get sucked into those false breakouts because you don't realize the macro regime is fundamentally draining the liquidity required to sustain them.
Knowing the theory is amazing. It fundamentally changes the way you see the world. But how do we actually execute? When a trader sits down at their desk tomorrow morning, what is the mechanical process? Let's give you the 4-step practical framework.
We need to turn this philosophy into an actionable, rigid checklist. This is a process you must apply to your analysis every single time you interact with the market.
Step 1, identify the regime. You start at the top layer. You look at the macro weather. You ask yourself, what fundamental forces are dominant right now?
Are we expanding or contracting?
Right. Is central bank liquidity expanding or contracting? Are interest rates rising or falling? Are we in risk-on environment or risk-off? And critically, do not look at a candlestick chart yet. Look at the data. Look at the yield curve. Look at the incentives.
Step 2, analyze structure. Now you open your charts. You observe the physical price behavior within that macroeconomic environment. Is the market trending cleanly? Is it trapped in a messy, low liquidity range?
Are we chopping around?
Is it transitioning from accumulation to expansion? How is volatility behaving? You are translating the invisible macro forces into observable footprints.
Step 3, identify active campaigns. Look for the persistent, heavy capital flows. You aren't looking for a stock that popped 10% on a random headline. You're looking for sustained directional movement backed by volume.
Real institutional size.
Which sector is systematically outperforming the broader market week after week? That is where the institutional VWAP algorithms are leaving their footprints.
And finally, step 4, align positioning.
This is it. This is the holy grail of market execution. You only take the trade, you only risk your hard-earned capital when regime, structure, and campaign are perfectly aligned and pointing in the exact same direction.
If the macroeconomic regime is bearish and liquidity is draining, and the structural layer is showing clear lower highs and lower lows, and the campaign data shows heavy institutional distribution out of risk assets, you look exclusively for short entries.
You do not try to catch the falling knife.
Exactly. If any one of those 3 layers is out of alignment, you sit on your hands, you protect your capital.
Because if they aren't aligned, your mathematical edge drops to 0.
What is genuinely tragic about the retail trading industry is why most fail to implement this. Most traders are utterly obsessed with the microscopic movements of price. They stare at 1-minute charts for hours.
Looking for magic signals.
They completely lack a conceptual language to describe what is happening above the chart.
And frankly, they desperately want the market to be simple. They want a red light and a green light. But the market is not simple. It is a wildly complex, multi-dimensional system of global capital. Attempting to oversimplify it doesn't save you time. Oversimplification destroys your edge.
Clarity creates edge. You do not need 20 different momentum indicators cluttering your screen. You do not need a faster news feed. You need to think clearly, fundamentally, and sequentially about how markets are truly organized.
A hierarchy.
Context, which is the regime. Interpretation, which is the structure. Execution, which is the campaign.
When you look at the market through that specific, multi-layered lens, everything changes. The chaos on the screen starts to make sense.
It ceases to be a random slot machine and reveals itself as a highly structured, logical system of hydrodynamics and capital flow.
And that brings us to how you are going to look at the market tomorrow morning. When you wake up, pour your coffee, and open your terminal, you are no longer going to just see chaotic red and green lines bouncing around a screen.
It won't be a blur anymore.
You aren't going to see random noise designed to stop you out. You are going to see the breathing, multi-dimensional architecture of global capital. You will see the incentives of the regime, the behavior of the structure, and the movement of the campaigns.
But this raises an important forward-looking question for you to consider as we wrap up. We are moving rapidly into an era where highly advanced algorithms and artificial intelligence are increasingly dominating the short-term structural layer of the market.
It's accelerating fast.
They identify structural patterns and execute trades in fractions of a millisecond, actively hunting retail liquidity.
That is a fascinating dynamic. If the machines essentially own the short-term structure.
Exactly. If AI and algorithms eventually perfectly price the structural layer, will human traders eventually be completely priced out of short-term trading? Will human intuition only be able to find an edge by mastering the slow-moving fundamental regimes, the complex intersection of geopolitics, human psychology, and central bank policy that machines currently struggle to contextualize?
That is the exact question you need to be thinking about. As the market evolves, where will your edge actually live? Keep asking those big questions. Keep analyzing the layers. And remember, the next time you see a massive short-term rally and you feel that overwhelming urge to bet the farm, pause. Ask yourself, is this a campaign or is this a regime? Don't get stopped out by the blur. See the layers. Understand the game you are actually playing. Keep diving deep.